Aloha, this is Kurt Nielsen with eMorgage Hawaii, and this is my mortgage rate and housing forecast for 2015. Today I'm going to talk a little bit about where rates are and why rates have declined so sharply over the last 3 or 4 weeks, and why we project that they're even going to go lower, probably break the all-time historic low for mortgage rates. I also want to talk about some changes in the lending industry. Conforming loans are now up to 97% loan to value, so you only need 3% down. And in fact, that 3% can be a gift from family. FHA has also lowered their mortgage insurance, so that's a nice improvement we've been waiting for. Also, we're going to talk a little bit about jumbo loans. There's a lot of new things happening with jumbo loans, interest-only loans, also 90% loan to value with no mortgage insurance. We also want to talk a little bit about what Fannie Mae is doing with their uniform collateral data portal. Just some things that you need to know. I don't think this is a big deal, but it's an important information because it might delay escrows a few days if you've got an appraisal that doesn't score highly with Fannie Mae. Finally, we're really going to get into the meat of mortgage rates, why they're so low, where they're heading, and also for housing both nationally and here in the state of Hawaii. Let's talk a little bit about where rates are right now. Today you can get a 3.5% 30-year fixed with no points and even a rebate. So this is quite a large drop over the last month and a half, 2 months, and we were easily over 4% just 8 weeks ago. The 15-year fixed is as low as 2.875 with no points and a rebate, and even the ARMs are now dropping down. As you can see, there's not a huge difference between the ARM rates and the fixed rates. Jumbo loans are also very low, following right behind conforming rates. 30-year fixed up to $4 million, you can get at 3.875 with a very low fee. And the ARMs are very close to what conforming rates are right now on jumbo loans. So good news for the industry, good news for buyers here in Hawaii, and hopefully it will spark some additional demand as we head into the spring. So let's talk about really what's driving this. If you look at the mortgage-backed securities market, this is the Fannie Mae 3.5% bond. Remember that as the bond price goes up, rates go down. And you can see since late September, we've slowly seen these rates improve with some some declines in the bond market, but then reversing and going right back up. Today we closed at the highest rate for mortgage-backed securities that we've had in over 2 years. And we're going to test this, the lowest rate of all time, which is back in October of 2012, and we may break that. So we're heading that direction, and my forecast is we may get to be as low as that October 2nd date in 2012 and might even go lower. Okay, some changes in the mortgage industry. I mentioned that conforming loans are now at 97% loan to value, so buyers only need a 3% down payment. So this really displaces FHA loans. These funds, the down payment can be from gift funds. Also, a lot of people are now looking at lender-paid mortgage insurance, where the mortgage insurance is built into the rate. I think it's a much better deal for most buyers, so they don't have a big mortgage insurance payment, and it only increases the rate slightly. And remember that FHA requires a 3.5% down payment and a 1.75% upfront fee for their guarantee fee. And again, as you all know, USDA and VA still offer 100% financing. USDA does have a guarantee fee of 0.4% or 0.45% on the life of the loan. VA does not. So great loan options for first-time home buyers and those that don't have big down payments. So really no reason for somebody to be sitting on the sidelines waiting to purchase. As we mentioned, FHA loans, there's been a substantial reduction in the mortgage insurance. So if you're borrowing less than 95%, the mortgage insurance has dropped from 130 bips down to 80 bips. And if you go over 95%, it's dropped from 135 to 85. You still have to pay that upfront 1.75% fee. And remember, the mortgage insurance is for the life of the loan. And FHA loans are really for those borrowers that can't get any other loan. It's the most expensive loan, although the rates are very good, but mortgage insurance is for life. Generally, we reserve this for credit challenge clients. Okay, and on to jumbo loans. There's a lot of new lenders entering the jumbo market. At the beginning of this year, we now have interest-only loans. Right now, we have them available on ARMs. I expect that's going to flow into the fixed-rate loans at some point. You can also get up to 90% loan to value with no mortgage insurance, so that kind of eliminates the reason to go into an 80% first and maybe a 5 or a 10% second on a HELOC. We also have jumbo loans for clients that have many, mortgage properties. So now you can get unlimited properties with a jumbo loan. And we're also seeing an expansion of the number of lenders that are offering condotel loans and non-warrantable condos. So that's loosening up too. So really, a lot of good news in the mortgage lending market. The bad news is underwriting is still underwriting. The paperwork is the same amount of paperwork. The good news is we're used to it now. We know what's going to get through, what's not. So even though the paperwork is still pretty laborious, there's certainly less surprises. So that's been good for the business. I'm sure a lot of people have heard about Fannie Mae's Uniform Collateral Data Portal. Basically now they are not only underwriting the borrower, but they're underwriting the property. So each property that is appraised through a loan that is going to go to Fannie Mae is stored in a database with Fannie Mae and given a score of 1 to 5. Appraisals that are completed and to be sold to Fannie Mae will be run through their automated system. It just takes a few minutes to get the appraisal run through. And the appraisal will be rated on a score of 1 to 5, 1 being the best, 5 being the worst. Each appraisal will be compared to up to 20 comps, and those comps will be used to rate the appraisal. So I think the end result of this is that, on occasion we're going to have situations where the lender is going to require the appraiser to make changes to the appraisal, or that appraisal can be denied by the lender if it gets a low enough score. So just be aware that this process is going on. It may cause a little bit of delay. I think in the long run it's good for the industry because I think it's going to winnow out appraisers who really are not doing their job and are doing things are inaccurate. For example, if they use a comp that's already in the Fannie Mae database and they misquote the square footage, they misquote the sales dates, it is going to raise all those red flags. So they got to do their job and they got to do it right. But it may raise the cost of appraisals. So again, it can add some time to the process. So just be aware of it. I frankly don't think this is going to be a big deal. And I think in the long run, it may actually help the appraisal process winnow out poor appraisers. So we'll see how this goes. It's in beta test now. It'll be released in about 2 weeks. And so in 2 weeks, we'll be seeing this on most appraisals. Okay. So let's talk about 2015. There's a lot of things happening, and probably the most important thing is the US dollar. It continues to strengthen. And the reason for that is the U.S. economy is just simply better than other economies. If you look at the European Union, there's a lot of trouble in the European Union, and now the European Central Bank is looking at quantitative easing efforts to do the same thing that our federal government did in trying to spark the economy. And in Japan, they're all in trying to create inflation in Japan and devaluate the Japanese yen. So a lot of this is pushing up the dollar and moving investments from other countries into the United States. As all that money pours in, there's a bigger demand for treasuries and mortgage-backed securities. That inflates the price and reduces rates. So that is a positive motion for interest rates here in the United States. And I expect this thing to continue and rates to even go lower. Also, we have very low inflation right now, and in fact, we may be headed for deflation. As you know, oil prices have dropped precipitously. We're now at $46 a barrel. These very low energy costs will play into all goods. And not only will we have low inflation, we might see no inflation or even deflation, which is a little scary. We're going to talk about that here in a minute. Again, the strong dollar forces foreign investments into the United States, but it most likely will reduce foreign buyers into the Hawaii real estate market. If the Canadian dollar is weaker, the Australian dollar is weaker, and the Japanese yen is weaker, probably less foreign buyers for Hawaii real estate. That remains to be seen, but I would think that would be a logical conclusion. However, I believe that lower interest rates will fill any gap of foreign buyers. I do expect Chinese buyers to continue into the market. That probably will not be interrupted, but Canadians, Australians, Japanese, I think that will affect their purchases here in Hawaii in 2015. On housing, the rising rents is certainly making housing more attractive, and these low interest rates are qualifying new buyers and also buyers that were unqualified. Now they got their 2014 tax returns. We've got a lot of people that are now qualified to buy homes, and I think that we're going to see them moving into the purchase of property, especially since they don't have to put any more than 3% down to get a conforming loan. Again, underwriting is still tough, but again, there's more loan options. We're getting used to the underwriting, and I think there's less surprises. Nationwide, we're projecting the housing market to rise 3.5% to 4% next year. Last year, we called it perfectly. We were saying 5.5%, and that's exactly where we landed. I think in Hawaii, with a declining foreign buyer base, I think we're going to see Hawaii kind of keep pace with the rest of the nation. There's going to be some bright spots and some dull spots in the state, but I think overall we should kind of follow the national trends. Again, I think the lower rates will buck the loss of foreign buyers. In West Hawaii, we've seen an abnormal rise in housing prices, mainly because of the inventory loss of the low-end homes. So I think West Hawaii is going to stabilize a little bit in 2015. We certainly aren't going to see the high double-digit growth that we did in 2015 or 2014, and I think we should stabilize well below 10% year over year. If we look at Oahu ended with 3.9% year over year in home prices. I think we're going to expect something similar for Oahu. Maui ended with an 8% year over year in home prices. I think that's going to drop maybe 4 to 5% in 2015. But again, these low interest rates, might really make a push. So I think conservatively we ought to think about 4 to 5%. And the Big Island ended the year at 7.6% year over year, and I again think we should see that drop a little bit. With West Hawaii being a strong anomaly with a 24% year over year, but again that was distorted by the number of low-end homes that were sold. We just ran out of inventory, so that kind of distorts the figures a little bit. But I think we should see that figure drop to well below 10% next year. And Kauai was kind of a surprise this year. We had only a 1.14% year-over-year rise in prices. Not sure what drove that. Maybe it's inventory. I think we should see a better year in 2015, especially with people recovering their incomes, becoming eligible for lending and getting outside of any foreclosures or short sales. So again, I think the housing market in Hawaii is going to be, strong next year, and healthy. We don't want to see too high of an escalation. I think that's bad for the market. 4 to 5% is very healthy. Oil is a major issue going into 2015. There's a lot of people that think that lower oil prices are good. Of course, cheap energy costs do increase disposable income, but when you really look at it, if somebody saves a little bit on their gas every month, they might save $10, $15, $20 a month. That really isn't going to spark, in my opinion, the economy. but we are producing a lot more oil than we were before. That's a big deal. We're producing 94 million barrels more oil than we were 2 years ago, and that money stays in this economy, so that part is good. Um, Certainly, if oil prices continue to drop, we're talking about losing jobs in the oil sector. And remember that 11 out of the top 12 appreciating real estate markets were in the energy-related markets. So I think further drop in oil prices could have an effect on our unemployment rate, and certainly in those markets that are dependent upon the energy sector, like Texas, Oklahoma, North Dakota, Alaska, those markets might start having some problems. Colorado. But here in Hawaii, we are not so focused on that, obviously. So lower energy prices help us here in Hawaii, but we will lose those buyers that are affiliated with the oil industry, and I've already seen that. So people that were looking at buying real estate, but they're getting a little nervous about their jobs or their investments in the oil-related businesses. So you're going to see a little bit of that dampening. Certainly, stocks are nervous about lower oil prices because it does have an effect on the unemployment rate. So we're going to see where this goes, but I think we're in for a long run at $40-45 per barrel oil, and I certainly don't see that jumping up sharply. You have too many economies that are dependent upon those oil revenues, like Russia, Venezuela, OPEC. So I think production is going to stay high, and these oil prices will stay low unless demand picks up sharply. And I think just the opposite's happening with people buying more efficient cars. So I don't see $100 per barrel oil anytime soon. Years away probably. Okay, let's talk about rates. With the Fed, we're in a win-win situation. The new voting members for the Fed are very dovish. That means that they are probably not going to be willing to raise interest rates. There is now a fear of deflation, and they really don't have a lot in their arsenal to combat deflation. Interest rates are almost at zero. More quantitative easing, they could probably do something like that. I don't know. But there is no inflation in sight. So I know a lot of people are predicting rate hikes by the Fed, but I think at the very earliest it's going to be near the end of the year, maybe one rate hike, maybe two, but I don't see this affecting interest rates or mortgage rates until we get into the fourth quarter. And again, I think low oil price is going to push rates even further down. And then foreign yields on, like foreign bonds, they're so low that there's going to be a lot of money pouring into U.S. bonds, and that will continue to drive interest rates low. And again, the strong dollar is the key behind all of that. I'd like to give you an example of what I'm talking about here on foreign investment. As more money pours out of places like Europe and pours into the treasuries and U.S. and mortgage-backed securities, it just drives the prices of those treasuries and bonds up. As the price goes up, rates go down. So let me give you an example. If you're in Germany and you had 100,000 euros to invest, you could invest it in the German bond and get, about a half a point return. So a year later, you're going to have 100.5 euros. It's really almost not worth investing. Now, you can move those euros over here to the United States. Let's say you convert 100 euros into dollars, you get about 120. Today, that's a little bit lower, but the same philosophy holds true. So you get about 120 euros. Our yield on the Treasury, again, it's a little bit lower since I made this slide, but if you look at a yield of about 2%, a year later you'd have $122,000. So you can, and then a year from now, most likely the dollar will strengthen, and you can go back and buy back euros at maybe par, 1-to-1. So you would have made 122,000 euros by investing in the United States versus only a half a euro if you stay in Europe. So that's really what's driving all this. And I think this is going to continue until the dollar stabilizes and the euro stabilizes. So that's just there's too many people that are not going to put up with a half a point return on their investments in Europe. So I expect this thing to continue and mortgage rates to continue to drive lower. So I do see low rates through much of 2015. I don't see anything pushing rates up until we get into the latter part of the year. I think this is a huge purchase and refinance opportunity for everybody here in Hawaii. I also think the 10-year Treasury note may drop as low as 1 to 1.5%. Again, that's just the overall reduction in interest rates here in the United States. And I believe we're going to hit the 30-year fix somewhere between 3 and 3.25%, and that'll probably happen in the first half of 2015. Again, I mentioned I don't think mortgage rates will start rising until the dollar stabilizes and Europe and Japan start showing some economic improvement and their currencies starting to stabilize. That can probably be, in late 2015. So I think for the first half, we're looking really good, maybe even through the first 3 quarters, and you'll probably start seeing some rise in interest rates as we get in later part of the year. Now, a lot of this has to do with oil. OPEC is an unknown, Russia is an unknown. They could maybe change the way they're doing things, but I mean that's something that we can't completely predict. But I think they're so dependent upon oil revenues that I don't see them cutting production substantially. But if they do, that could certainly change some of these forecasts. So all of this is good news, I think, for the Hawaii real estate market, especially over the next 6 months. I think this information needs to get out to buyers that this is going to be an opportunity to jump into an historic mortgage that, again, we may never see again in our lives. So again, if you have any questions, call me at 334-6201. I also would like to talk to you about my my listing marketing system. It's working fantastic. Cost you $1 a month, unlimited listings. I'll create websites for each of your listings, provide sign writers for your signs so that when people drive by, they can text your sign, get a virtual tour right on their cell phone with all of the information about the property, photos, selling prices, square footage, everything, and you're instantly being texted their phone number so you can pick up the phone, call them while they're still in front of your listing. I provide all of this for $1 a month, unlimited listings. It is a co-marketing, co-branding type of program. So, hopefully it's going to be something that I can generate some leads off of too. Again, call me 334-6201, and let's look forward to a great 2015.